one swallow does not a summer make. And while the Indian markets, as also the global markets, this Tuesday morning seem to be heaving a sigh of relief, the question to our guest would be, how does he see the overall landscape, the current FI selling that we've been seeing, actually not current really, the FI selling that we've been seeing in the whole of FY22, and the investing landscape at large. Andrew Holland, CEO of Avendus Alternate Strategies, joins me right now on Talking Point. Andrew, great having you. Thanks for joining in.
Thank you. It's always a pleasure.
Thank you so much. Andrew, first, the risk of, presumably due to the Omicron worries, you reckon overdone? Or is it difficult to say whether it's overdone or completely over?
See, I'm not sure it's the Omicron worries because, even though, we have seen a few more lockdowns recently, it was 2 to 3 weeks ago you started to see, borders being closed in Europe, restrictions starting to happen. I suppose, if you think about this time last year, we were coming into 2021 with a lot of optimism about the new vaccine. Yes, there was a worries over the Delta variant, but you had a kind of a way forward. I think this time around, it's with Omicron, it's because of the boosters. I think there's a little less worry about how long the lockdown will happen, because whilst it is very transmissible, it doesn't seem to be leading to a big increase in hospitalizations at the moment. So I'm not sure it's the Omicron. I actually think it's the Federal Reserve. And the reason behind that is, throughout 2021, we were told inflation is transitory, and now all of a sudden, let's forget that word. Now, in that, did they make a misstep or policy misstep by not tightening quicker? So going into 2022, will they try and make up for lost time? Now already the tapering is saying by the end of March will be finished, and then interest rates 3 now, not just 2, 3, probably start by June. Is that going to force the economy and markets down? Because we're still grappling with this inflation problem. And I don't think the confidence is there in the Federal Reserve now to say that they've got our back. So whilst we're seeing a bounce in the markets today, unlike previous times where you can say, okay, buy the dip, you had liquidity backing you. Going into the first quarter, all of that's going to evaporate. So I think it's going to be, I think the only thing we're going to be talking about in the first quarter is heightened volatility as markets grapple with that kind of scenario. I think the other thing to watch out for all the viewers as well is look at the 10-year bond yield in the US and the 2-year bond yield in the US. If interest rates rise in the US, your shorter end of the yield, the 2-year, should start to rise. If the 10-year remains the same and that inverts, that usually leads to recession. That's the signal for recession. So that's what the market, I think, is going to grapple with. Is the Fed acting too late at a time when the economy might be slowing to fight inflation, and therefore you could lead to a big slowdown?
Now, if that is indeed the case, Andrew, would it be volatility with a bit of a downward bias for emerging markets in light of the fact that if indeed the rates are moving higher, then in all probability the dollar index and the dollar versus almost all the other currencies would definitely not weaken, and that would be an overhang for FIs for sure. Yesterday, somebody was telling me about how India has an additional issue of the trade deficit numbers not looking all that great, and that also weighs in on the rupee. What's your sense about this whole mix of currency and the importance that foreign institutional investors will give to that in light of a rising interest rate scenario in the West, at least?
That's a great point. So here's what I think about is that for foreign investors, they've been taking risk off the table over the past month. Now you can say, okay, it's India, but it's emerging markets generally. It's currencies, emerging market currencies generally. It's commodities generally. All are down 5 to 10%. So when interest rates rise, it's your riskier assets, which include emerging markets, which are going to be hit. Now you're right. our current account trade deficit is high. So if borrowing costs are going higher globally, it's going to affect India a little bit more than some other emerging markets. I think the switch from a lot from FIIs has been towards other cheaper markets like China, which is, whilst it's there's still a lot of problems there, it has stabilized in terms of some of the policy reforms that they've been doing. So the kind of relative valuations are a lot more kind of compelling to kind of move away from. Listen, India's been one of the great performing markets this year, right? So falling 10%, I don't think is anything bad, but is there more downside? I think there probably is. Maybe another 2 to 5, between that 200-300 points more before we kind of, I think, kind of settle down at the bottom. But interestingly, Niraj, I think one thing. Let's think about China, right? So China went into COVID first, came out of COVID first, started easing first, and then started tightening, and now is easing. And the rest of the world has been the opposite of that. But in their tightening, what happened? All of these property companies, kind of came out of the woodwork and had a lot of problems. That's the scenario no one's thinking about in the West, about all the high debt that not just the central banks are carrying, but companies as well. And I think that's going to worry the markets to my mind.
Is India a relatively better place, in which case, and corporate balance sheets are far from being leveraged? If anything, they are in the healthiest shape that we've probably seen them in a long time. And somebody again was making this point that unlike the previous instances, wherein the rupee, there could have been a run on the rupee, so to say, because of the abyssal levels of forex reserves in the past. This time around, the RBI is armed, and speculative activity on the rupee cannot be as high because they know that there is a backstop that the Reserve Bank could put if it wants to.
Yeah, no, that's a very valid point, and I think that will give investors a lot more confidence going forward that the rupee might not depreciate as much as it has done in the past. But the problem is maybe not India; it's other emerging market currencies. I mean, I'm sure you've read about Turkey and what's happening there. Mexico also. It's that contagion part which just has people. If you think the rupee could depreciate as a foreign investor, and you think the markets might kind of, take whatever fall from here, you're going to take money off the table. You're being hit on both sides, falling stock prices plus a weakening currency. So I don't think India. I think it's going to be maybe a year of two halves. The first quarter being heightened volatility, settling down where we are. Will the Fed still be increasing rates or not? And I think that will all play out in the first quarter to the first half. And thereafter, then I think investors will start saying, okay, well, emerging markets, India is a growth engine still. It's got strong domestic economy. If the government can really kind of kickstart this kind of infrastructure spending, then you'll start to get the private capex coming forward. But I also think you're going to see foreign direct investment come into India in a many different, whether it's manufacturing or services next year, because whilst there are problems still in China, I think India is standing tall in terms of a destination with huge amounts of growth going forward. And I think we'll see that will help again kickstart that kind of capex cycle, and that has a great multiplier effect. So it might be that kind of first half, second half kind of scenario for India, just suffering because we're an emerging market, but having our own kind of tailwinds, which will grow the domestic economy, and therefore investors will come back. So I'm not overly negative, but I just think the global markets are not pricing in some of the policy missteps which I'm seeing at the moment.
So Andrew Holland has a pot full of money to invest, right? Is Andrew Holland fully invested in India? Is Andrew Holland sitting on a bit of gunpowder to account for the volatility?
I was sitting on quite a bit of gunpowder actually, because we came into that kind of November, December period in our funds with higher hedges, and obviously have taken down the funds that we deploy, because when you have so many moving parts, and there are so many moving parts, we haven't talked about other geopolitical problems, Russia, Ukraine, which and then China, Taiwan. So all of these, just in the background, we're not sure what's going to happen. But to my mind, just letting the kind of dust settle, see what the policymakers are saying, come the first quarter, will give us some indication. But at this moment in time, it seems to me that we're tightening at a time when the markets at valuations which would not allow for a slowdown.
Okay, so Andrew, with the presumption that not with the presumption really, with the knowledge that you are not fully invested and sitting on fair degree of cash, maybe the highest in a number of months or what have you, where is it that you are staying invested, and what are the pockets that you believe you might look forth to? Again, valuation is a different kettle of fish. We don't know what it will settle down at. So just give us a sense of how do you see the Indian landscape and the scenario, now that we've spoken about the globe.
So at the moment, we're doing what we normally do, which is hiding. So when we're invested, we're hiding in the kind of IT, FMCG, telecom, and selective pharma. That's where you need to hide when markets are kind of being volatile as they are. I think going forward though, Niraj, as we kind of just come through this, see, for example, I don't know about you, but am I going to travel overseas until all of this kind of, in terms of whether you can come back, what tests you need, lockdowns, no lockdowns? I'm going to wait till that happens. So I'm going to spend, if anything, I'm going to just kind of travel around in India. And obviously a lot more people than me are going to do that. So I think the reopening, whether it's the hotels, leisure, anything to do with travel within India, I think is going to be the place to be. And it's not just India, I think it's going to be globally as well. If I'm in the UK, I'm just not going to go anywhere apart from locally for at least the first quarter. So therefore, I think, that's a theme that will play out. Now, timing on that is obviously a little bit kind of variable because, is Omicron going to take hold in India? We're not sure yet, but if it's not taken hold by kind of, late January, February, then maybe we can start to see that theme play out. I think the other themes that we're looking at going into the new year would be obviously the continuation of digitization. I've been doing quite a bit of work on this metaverse, and it's just a massive concept which I think will take off. And obviously that needs not just 5G, it needs 6G, it needs lots of things, but that's going to be developed very quickly, I think. So I think the telecom sector is going to be a big beneficiary of all of this. I'll be looking at some of the IPOs which have listed or will list in these volatile markets, because you get some good entry points when markets are volatile, and obviously people can see some good profits in some of these IPOs, or they don't list as with a premium as people were expecting maybe a month ago or 2 weeks ago. So those are the other companies we'll be looking at. And I think, anything to do, and I'm saying about infrastructure, but I don't know how to play it so well. So I'm going to look at the material side of playing that, whether it's real estate or, building a new factory. Someone's got to provide steel and cement and so forth. So I'm going to look at those because, whilst it's easy to look at the kind of L&Ts, the VHLs and so forth, but it's all about execution, and it just takes a long time for them to get through. So, I look at these stocks only in terms of, I think the share price follows order flows and not necessarily follows the execution part of it, because it's usually, doesn't happen as quickly as we would hope. So those are the kind of things I'd be looking at. And of course, IT will continue to have the tailwinds, and I think select pharma will continue to have the tailwinds. Within the financial sector, I'm kind of, the banking sector, the private banks, there's been a lot of changes, right, in top management at the private banks. And I think we're still waiting to see which is the pecking order, who's really taking that lead. And there's a lot of disruption happening alongside that. So I think I'm going to look more at the insurance companies, because health, we still need to do that. And I'm going to look at asset management companies, because I think, again, after the recent kind of sell-off, we know that people continue to use the markets as a way of investing going forward. So it's financialization of people's savings, I think will continue. And I think that's great for asset management.
And the last couple of questions, you mentioned financials, and the bank Nifty's had a vertical drop since the October 25 peak. Some people corroborate that to the massive amount of FI outflows as well that we've seen in OND. Two-part question. One, when do you reckon this FI selling ends? Because when I was looking at the numbers, it's not just October, November, December. Save for one positive month, FIs have been net sellers in India in each of the last 8 or 9 months. So when do you think this ebbs a little bit, if it does? And does that mark the trigger point for banks which are heavily FI owned to start making a bit of a pullback?
Yeah, I think that's correct. I think FIIs, when they come back to India, whether it's through index or directly, you're going to have a weightage in the banking sector. It's a huge weightage in Nifty. So that goes without saying that they will do. But I think for a lot of FIIs, it's which bank now. Traditionally you go for the HDFCs, but there's some newer managements in some of these banks which they're standing out. So I think that pecking order is just changing a little bit from where it was before. So I think they will come back, but I think it's going to be if the first quarter is as expected volatile, then I think they'll probably sit on the sidelines unless there's a big global sell-off in India. Comes down to more reasonable valuations from where we are today, then I think they'll come back across the board.
Okay, but as of now, it's difficult to say when, right? It has, maybe, is it global a move in nature?
I think it's more global. I don't think anyone's saying that India doesn't have the growth going forward. But don't forget, the RBI is going to have to come and increase rates at some point in the first quarter. So again, that's will that slow industry? Will it slow down lending? So I think these are going to. But on the sidelines, it's all this disruption that's happening in the banking sector. And I think Uday Kotak said, we haven't really. I mean, as a banking industry, we haven't really kind of been at the forefront of this. So I think that sent a few signals to people that that they're seeing competition from many different areas.
Got it. Andrew Holland, always a pleasure talking to you, more so today on such a day. Thank you so much for accommodating our interview request, and have a great holiday season, and Merry Christmas to you and family.
Yes, and Merry Christmas, obviously, to you, family, and all the viewers. Have a good one.
Thank you, Andrew. Stay safe, and viewers,
Thank you.
Thanks for tuning in.